yes, markets have had a very strong recovery from COVID. If you look at the COVID recovery and compare it to like the Great Recession after the financial crisis in 2008, 2009, it took us about 10 years to get back to sort of the previous high watermark from an overall economic standpoint. In terms of COVID, it took us, less than 18 months, really, just about a year to kind of get back to where we were prior to the pandemic. And so that's really interesting when you think about how quickly the markets and the economy has recovered. It also really illustrates how important it is to kind of divorce ourselves from the emotion, that is inherent in investing in building portfolios, and really focus on the framework. Because, take last year, for example, 2020, if you had invested based on how you felt, you would have sold out in March or April. You would have sold out of risk assets in March or April, and you would have missed out on this really tremendous recovery that's taken place in a very short period of time. Back in March and April, we were actually, talking with clients about, at the very least, maintaining positioning, and if, and in many cases, adding to the risk asset side of the portfolio when markets were down materially, rebalancing some assets onto the risk side because prices and valuations had fallen so dramatically. The issue that we look at now, though, is, the S&P 500 this year is up about 18% year to date. And, we're just a month past the halfway mark of the year. That's a very strong return. Do I think the S&P 500 is going to be up 20% or 30% this year? I venture, my opinion is probably not, because we're also coming off a really great 2019 and a really great 2020. And if you look at longer run averages for the S&P 500, over the last 10 years now through June 30th, the S&P 500 is annualized at over 15%. And that's astonishing, because that's probably close to double the really long run historical average of the S&P 500 going back to, the 1920s, sort of the inception of financial market data. And so, as we know, this concept of reversion to the mean is really the most powerful force in investing. So when you have a market that's trended at double its long run historical average for 10 years, that creates some valuation issues for us, meaning that markets are expensive. And so that is, it's a bit of a concern, because in investing, we like to buy when prices and valuations are low, and then we like to sell when prices and valuations are high. Not saying we need to sell today, but it is a bit of a concern when we see valuations as high as they are today. Now, you counterbalance that with the fact, though, that everything's expensive. And this is in large part a result of the massive amount of stimulus and aid and money printing that's taken place through our Federal Reserve and through our federal, state, and local policymakers. There's just a tremendous amount of liquidity sloshing around markets today, and that's driving prices of everything up. So even though valuations are high today, doesn't mean they can't stay high, and it doesn't mean they can't go higher. What I do think, though, in terms of the rest of the year, I think we're going to see some significant volatility in markets, or equity markets will bounce around. And I do think that COVID and our continued progress as it relates to the global pandemic is really going to drive markets in the back half of this year. If we've heard about mask mandates coming back to some extent in some areas. Biden administration is recommending that even vaccinated folks wear masks again indoors if you're in an area where case counts are rising. That's rolling back the progress that we've made. And that makes folks fearful that, we may end up having more shutdowns in certain parts of the economy and those sorts of things. And that, if that happens, that's likely to cause volatility in markets. What we're hearing and what we're reading about in terms of, of everything that's been talked about thus far, what could be likely to happen is, yes, tax rates are likely to go up a little bit. So federal income tax rates are likely to rise, but not super dramatically, and particularly on the highest income earners above 400,000 has been thrown out there. Above $1 million of income has been thrown out there. Capital gains rates will probably go up a little bit, but everyone that we're talking with and and hearing from thinks the notion that they would go up to ordinary income tax rates is a non-starter. So while there may be some rise, it's not something where you say, okay, we need to sell assets today to avoid a slightly higher tax that may or may not happen in the future. And then the corporate tax rate is likely to come up a little bit as well. The Trump administration decreased the corporate tax rate meaningfully, and the Biden administration has signaled that they want to raise it a little bit. So of everything that's been talked about, those are some things that seem maybe more likely to come to pass than some of the other things. Still a lot remains to be seen if and when it would actually take place. While it may not be, a perfect time today, and again, it never is to invest, we need to be invested to allow time to help us, and we build portfolios to deal with that short-term uncertainty. So, the risk is that you invest today and markets go down a little bit. That may happen, but that's okay, and we can rebalance portfolios if that happens, and we can change portfolios based on what markets give us. But the opportunity cost of remaining in cash today or staying uninvested is far greater than the ultimate long-term risk of investing in a diversified portfolio of assets.